All right, if you've been anywhere near the markets lately, you've definitely seen the fireworks. Gold and silver have been on what you can only call an historic run. But what's really going on here? Is this just another speculative bubble, all hype? Or are these prices trying to signal something much, much bigger about the future of our money? To figure that out, we need to play detective.
So let's just start with this number, nearly $5,600. Now, based on some projections, that's where gold could be heading by January 2026. A move like that would be its best yearly performance since 1979. I mean, it would catch a lot of people by surprise, that's for sure.
And if you think that's wild, get a load of silver. In that same scenario, we could be looking at a surge of 147% in a single year. That would blow past the $100 an ounce mark for the first time in history. That's not just a rally, that's a full-blown explosion.
And this gets us to the heart of it, right? This is the central question we're here to unpack. Are we just looking at a classic speculative bubble, fueled by hype and just waiting to pop? Or are these prices a rational reaction to a massive generational shift in the whole global money game? To answer that, we've got to follow the evidence.
Okay, so let's dig in. Price moves this big don't just happen out of nowhere. Our analysis shows there are 5 deep structural forces all pushing in the same direction. So let's think of them as clues. And if we follow them step by step, the big picture should start to become a lot clearer.
All right, our first clue, and it's a big one, the U.S. fiscal situation. To put it bluntly, it's on a path that is really starting to shake people's confidence. At its current speed, the national debt's on track to blow past a staggering $39 trillion by early 2026. The sheer size of this thing is forcing the whole world to rethink risk.
And if you're trying to wrap your head around that number, listen to this quote from the Nonpartisan Committee for a Responsible Federal Budget. The interest we pay on the debt is now $1 trillion a year. Let that sink in for a second. That one annual payment is more than the entire national debt the country built up over its first 200 years. That's just mind-boggling. On to clue number 2, the dollar's slow erosion. Now let's be really clear. This is not about some dramatic dollar collapse headline you see on YouTube. No, this is about something much slower, much quieter, but it's very real, and you can actually measure it. The steady decline in the dollar's dominance.
And you don't just have to take my word for it. The numbers tell the story. Since 2016, the dollar's share of global central bank reserves, well, it's dropped by 8 percentage points. Now, in the slow-moving world of global finance, that is a huge shift. So the big question is, where's that money going? Well, it's not going into the euro or the yuan. Nope. It's going into hard assets, specifically gold. Which brings us perfectly to clue number 3, the central bank signal. And honestly, this might be the most important signal of them all, because it's not about what central bankers are saying. It's about what they're doing with their own money. And their actions? They're pretty much unprecedented. I mean, this chart says it all. You see the historical average? It was around 450 tons a year. Now look at the last few years, over 1,000 tons annually. That's more than double the old rate. This isn't them just playing the markets. This is a strategic long-term pivot. They're moving away from dollar assets that can be frozen or sanctioned and into neutral, physical gold they can keep in their own vaults. It's a massive change in behavior.
Okay, clue number 4 is all about silver, which is in a really unique spot. For basically the first time ever, you have monster demand for it as money and monster demand for it as a critical industrial metal, and both are exploding at the exact same time. It's a perfect storm.
And this table here shows you the result. For 6 years straight, the world has been using more silver than miners can pull out of the ground. And this isn't just speculative demand that can disappear. No, this is driven by unstoppable trends like solar panels, electric cars, and AI data centers. The market is in a structural deficit, and you can't just flip a switch and get more supply. And that leads us to our 5th and final clue. This one isn't on a spreadsheet. It's about trust. We're seeing this growing distrust in the whole paper financial system, especially the futures markets that set the so-called official price of gold and silver. Whenever you see that gap between the paper price and the cost of getting real physical metal in your hands start to widen, well, that's a classic sign of stress under the hood.
So let's take a step back. We've got our 5 clues: massive debt, a slipping dollar, central banks hoarding gold, a silver supply squeeze, and a growing trust issue. What does it all mean when you put it together? To understand that, we have to look back in time. Because history teaches us one really clear lesson. These huge monetary shifts, they never send a press release. They just kind of creep in quietly.
And you can see this pattern pop up again and again. Take 3 key moments in U.S. history. In 1933, the government just devalued the dollar against gold overnight. Then, from 65 to 71, they quietly pulled all the silver out of our coins right before they cut the dollar's last tie to gold. And after 2008, the Fed created trillions of dollars with quantitative easing. You see the pattern? It's always these gradual policy changes that have these massive long-term consequences for your buying power.
And here's the receipt from that last big shift. Since the U.S. finally and completely cut the dollar off from gold in 1971, that dollar has lost about 85% of its purchasing power. So a dollar back then buys you about 15 cents worth of stuff today. That's not a prediction. That's the 55-year track record of what happens to a currency that's only backed by faith.
So we've gone through the 5 clues. We've put them in historical context. Now let's get back to our original question. Is this a bubble or is it something deeper? It's time for the verdict.
And here it is, the crucial takeaway. The evidence does not point to a sudden, overnight collapse. It points to the beginning of a slow, grinding, generational transition. This is how these shifts actually happen in the real world. It might be less exciting than the internet hype, but it's exactly what the data suggests is unfolding right in front of us.
But, and this is a really important but, we have to be cautious. The dollar is still incredibly dominant. It's part of almost 9 out of every 10 transactions on the planet. And there's no credible replacement waiting in the wings. Plus, we have to remember what happened in 2011. Prices peaked, then crashed 45% and stayed in the ditch for years, even though the long-term story was still correct. It's a huge warning that sentiment can get way, way ahead of reality.
Okay, so we've got this messy picture of a slow transition. What in the world does that mean for you? What's the practical, real-world takeaway from all of this?
It really comes down to changing how you think about it. The real role of gold and silver isn't to make you rich quick. It's not a lottery ticket. It's insurance. Think of it as purchasing power insurance for the wealth you already have. Insurance against that slow, quiet, but constant drip, drip, drip of a paper currency losing its value.
And this is an insurance policy with a really long-term horizon. Just think, between 1980 and 2000, gold actually lost value for 20 years. As a short-term trading tool, it's terrible. This whole idea is a generational one, not a quarterly one. It's about preserving your wealth for the next 20 years, not trying to make a buck in the next 20 days.
So we'll end with this question. Back in 1965, the government quietly started taking the silver out of our coins. It was a subtle signal, a quiet warning that a massive change to our money was coming. Today, the signals we've been talking about, the debt, the central bank buying, they are arguably much, much louder than they were back then. So the real question is, are we paying attention this time?